So that first section, what is goals-based investing? And just a bit about the history. And when I was a young tucker, or maybe I should say younger tucker, I started my career at a firm called Watson Wyatt. And today they're called Willis Towers Watson. They're an investment consultant. And back then, more than today, basically every superannuation fund used a consultant like Watson Wyatt, Mercer, Jana, to advise how to construct their institutional size superannuation fund. And the process we went through to build that superannuation fund and monitor it and manage it on their behalf, talking to their trustee board, so trustee boards such as Telstra, Qantas, Q Super and so on, we all had this similar process, which might look a bit like the traditional advisor developing SOA process. And let me quickly talk you through it. So step one, up the top, you meet them, you agree what they're trying to achieve, and you set out the objectives. Obviously, there's a lot more to that, but I'm going to get through this quickly. And for a superannuation fund, it may be to, outperform our peers and deliver a CPI plus 5 performance over an X number of years. We then go through and define the risks that they want to think about, their risks to other peers, liquidity risk, how much they want to spend on active management. And then step 3, and this is the big one, step 3, we then set a strategic asset allocation based on a very broad set of long-term assumptions of risk and return to achieve that CPI plus objective. So if you want to achieve CPI plus 5, you should have 25% in Aussie equities, 25% in global equities, X% property, and so on. And we're going to set that in stone and only review it very occasionally, maybe once every 3 to 5 years. And that's going to become your benchmark that we measure ourselves against. And that's the critical part. So remember, we've set a fixed strategic asset allocation, and we're going to not look at that too often. And then step 4 is what we kept ourselves very busy doing for the next quarter on quarter, year on year, and that's actually filling those underlying buckets. How much we want 25% Australian equities, but what managers are going to be in that bucket. And we're going to label a benchmark to the Australian equities, the ASX 200 or 300, and we're going to spend all our time and resources thinking about the best mix of managers to outperform that benchmark. And if we add that 1 or 2% alpha at the fund level, we pat ourselves on the back, the trustee was happy, and we went round and round. We did the performance reports, which, because I was so junior, it was me having to do the performance reports, and then we'd take those to the trustee. They would nod their head or shake it if we'd underperformed that benchmark, and we'd go round and round and round in circles like this for many years, and this is how the super industry worked for probably early 90s till the next interesting point, which was 2008. So in 2008, as we all know, and then into 2009, most of those super funds in their default option delivered minus 30 or even worse % return. And there was a lot of questions asked from their investors and from the trustees that this was outside our expectations. This was never something discussed with us. This is not what our investors signed up for. And they looked for someone to blame or someone accountable for that. So I'll turn to you quickly. Now, does anyone have a quick comment on what could be labelled as maybe being an issue or insufficient element in this planning process for large super funds? So a couple that I just mentioned, who is accountable for large losses? So go around this circle, the asset consultant's done their job. They've set a long-term strategy. And their managers may have outperformed. So let's say your global equities did minus 50%. Your collection of managers may have done minus 45%, may have been actually asking for a performance fee, crazily enough. So the asset consultant had done a good job picking these managers, but the benchmark itself had been absolutely smashed. And there was no one actually accountable for what the benchmark might do. Who's actually going to stand up and say, yep, we got that wrong. It's us you fire, or it's us who should have been having our hands on the wheel. So that kind of leads to the second issue, that asset allocation itself, the mix of those benchmarks, is far more important in the actual total return outcome as opposed to the little bit of alpha above or below those benchmarks you add over time. So no one accountable, no one really thinking about what matters most, the mix of asset allocation, and perhaps maybe the definition of risk was a little off as well. So a lot of the risk in this framework was tracking error, which is a technical term, how much risk you're taking versus your benchmark. Really what matters to the end investor is how much can you lose? How much can I lose in a really bad scenario? I think that's what the investors were coming into the fund looking for, and that's nothing to do with tracking error or relative benchmark risk or peer relative risk. So there's a couple of points on the issues. What then emerged, you can come back to them when you get the slide information later. I've been through those. What then emerged out of this financial crisis and this lack of accountability, it has several names. So the asset consultant at the time, which I'd then moved on by the GFC into Australian equities quantitative portfolio management, but that asset consultant branded something called New Balanced. And why they called it New Balanced is that Old Balanced, or that model I showed you before, had no accountability for asset allocation, had no accountability for risk. But other people called it other things. Schroders came out with a real return fund. Perpetual, which is where I ended up not long after the financial crisis, came out with their diversified real return fund. AMP Capital launched one. Now BT have one. Aberdeen. There's many funds coming. MLC, I should mention. There's many funds coming out with new strategies that say we're going to be true to the goal of CPI plus, or a different goal might be to deliver a certain income, or it might be to mitigate negative returns. Whatever that goal is that the original investor went in a fund for, an investment scheme for, we're not going to get lost in setting a strategic asset allocation and then managing to that and then blaming the actual markets if something goes wrong. We're going to be accountable for the actual total return. So that ultimately means dismantling a benchmark. And that's very tricky, because then how do you start to measure people when there's not a firm benchmark to say, have you done a good job? You have to wait a very long time to know whether a manager without a benchmark has delivered that objective of CPI plus. So that's something we can talk about maybe later, about how to measure goals-based strategies. But that's basically a very short history, and I've tried to rush through that because there's some good stuff I want to talk about next, about what goals-based investing is to us. It's about aligning yourself to the end goal of CPI plus X%. It's about thinking about risk as how much you could lose, or what the volatility of the fund is. It's not about what you're doing versus a benchmark, because the client isn't aligned to the benchmark return. They're aligned to what they actually get in their portfolio. One thing I wanted to touch on as well, and I mentioned, I've put this in because this is something we often get asked. As advisors, you are all very familiar with goals, but I want to just articulate a little bit of a difference in the terminology here. I think every advisor since day dot is focused on their clients' goals, and there's been a lot of push in different practices. I know the AMP are pushing this through there, a goals-based advice system, laying out what your goals are in life, how you're going to achieve them, what financial backing do you need to achieve those goals. That is a different concept to what I'm talking about today, which is goals-based investing. And I guess it's a narrow line, but in my mind, it's quite separate. Goals-based advice is sitting down and laying out goals and how they're going to achieve them for an individual client. Goals-based investing is at the fund level, defining a very clear goal that a fund is trying to achieve, and then the underlying portfolio management and risk management being extremely focused on delivering that goal. So an example might be a fund targeting a certain level of income and maintaining real capital value. So that's a kind of goals-based strategy. Everything in the fund is focused on what income that's going to deliver and what downside there is if we pursue that income. Another goals-based strategy might be for people who are very young who only want to maximize total return and have no regard for downside risk. That's an interesting goal because it's not very much talked about, but someone very young should be focused on taking on your liquidity risk, taking on perhaps even leverage. So that's a goal, to maximize returns and nothing else, and you could build a portfolio around that. We don't really do that or talk about that, but I thought I'd throw it in there as the opposite end. And lastly, obviously, something I'm responsible for, a fund designed for retirees in drawdown who are more exposed to sequencing risk, and we need to manage that, have a different tax circumstance, need liquidity and access to their funds. So by defining the type of investor and the type of goal we're pursuing, we can design a fund more tailored to that, and then that then becomes another tool in your kit. That goals-based investment fund becomes a tool in your kit when delivering goals-based advice.